Thank you so much for that, Sumit. For years, we've been associated at ET now with Voyage 2020, but this is the first, the digital edition of Voyage. So, welcome to all our participants, and of course, welcome to all our attendees as well who are logging into this webinar right now. And with that, let me also welcome my panelists. Today, I have with me Chanchal, who tracks Fmcg, consumer durables, as well as the retail sectors, as also manages the Birla Gen Next Fund. I also have with me two Dhawals today. Dhaval Shah, he tracks pharmaceuticals, healthcare, diagnostics, and also runs the Pharma Fund at Birla. And Dhaval Gala, who tracks the BFSI, banking, insurance, and NBFC sector. Gentlemen, afternoon. Good to see all of you. Dhaval Shah, I must point out here, let me start the discussion with you first. Given that you track one of the hottest sectors right now, pharmaceuticals, that's clearly the flavor of the season. Let's begin by talking about the first pillar of growth here, revival in exports. After 2 years, Dhaval, of a decline, FY20 was pegged to be the year of consolidation and thereafter finally witnessed growth. Now, with this sudden, rush around finding a COVID vaccine, where do we stand in this journey?
Sure. So, let's take for a moment COVID out of the equation and understand, how the sector was panning out over the last few years. So if I look at a 10-year journey for this sector, it has actually gone up from being a $9 billion industry, and I'm only talking of pharmaceuticals and not healthcare combined, to today a size of around $38 billion. So, it's been 4x from 2008 till now as a sector that we are trying to look at. Within that, the first 7 years was gun blazing. Domestic was growing at 12 to 14%, and exports was growing at around 25% kind of a CAGR. Last 3 years have been difficult years for export business, and as you rightly pointed out, 2 years have seen a decline in exports. Now, what are the reasons because of which that actually happened? First, in the largest market for exports, which is US, there was massive customer consolidation. From earlier 7 to 8 buyers, the number of buyers got reduced to 3 because of mergers and acquisitions between themselves. And that is where there was a lot of pricing pressure, which actually happened for various pharma companies catering to that market. And secondly, there was a lot of plant issues which were there with companies, within India, because of which they were either receiving an, OAI or a warning letter or, an import alert in extreme cases, because of which product approvals were getting delayed. Now, last 1 year or rather 18 months, many of the plants which were having some kind of an, approval lag were all coming on stream, and, slowly and gradually plant approvals were gaining stream. And that is where, last year we called out that this year could be a year of consolidation, and from next year we are looking at growth. If we look at strictly the trends, within the export pie, what were we expecting is companies which are catering to complex generics or respiratory, or specialty should actually gain traction from here on. Now let's bring COVID into the equation and see what has happened. Incidentally, COVID has, helped in terms of expediting a lot of plant approvals on ground. So a lot of companies today are, announcing over the last many weeks that they've actually got that US FDA plant approvals, which are stuck up for quite some time. And at the same time, some of the companies have also got product approvals, which were meaningful in nature. So I think COVID-19 has, provided impetus, and, that should add to the overall growth phenomenon that we are trying to look at. So at the same breath, if I were to say that, how is the overall outlook looking like? We actually called out last year that the $38 billion industry by 2030 will become a $100 billion industry by 2030. And that is something that, we have far more confidence today that, we are on a right track to actually achieve that.
Sure. Get you in over here. Does it, feel that when it comes to consumption as a space, just about everything is going to change right now? Or actually consumer-facing NBFCs, is there bound to be more fear and risk perception as seems to be building into stock prices, even for some of the leading names right now?
So, if you look at NBFC companies, right, most of the NBFCs in the country have been retail-oriented and focusing on acquiring customers more, which banks have not been able to cater to or reach. So definitely market will differentiate among better run NBFCs and one facing structural challenges, whether it is wholesale real estate or stuff like that. But companies with strong parentage, better corporate governance would tend to come back. That's the first thing. Market stock prices do tend to be volatile. Today, the environment, whether it comes to liquidity, whether it comes to macro, whether it comes to uh, COVID, and how will things navigate from here are not clear. So we will not be right to understand which companies may go down under and may not survive. But with companies with strong parentage, corporate governance should come back fairly well. If you ask me, how do we look at NBFC companies and customer facing NBFCs right now? Generally, if you look at last few years, NBFC grew really well up to the time of 2018 when ILNFS issue broke out. Asset franchise is something what NBFCs relate to. They are the guys who do very well when it comes to assessing informal or self-employed customer segment, which is the largest population in the country. Then they are very well in collection efficiencies and meeting the customers fairly regularly. So maybe post-COVID, few things of these business model could change, but they always remain important and dominant category when it comes to lending business, as well as they would remain even in times after COVID. So netted, what I am trying to say or I am trying to conclude is on NBFCs, the better run, better parentage, and companies who have differentiation in terms of their product and delivery will come into will continue to remain important, and their prices or their multiples would come back at least to the average multiples they used to trade earlier.
Sure. Chanchal, just taking a leaf out of what Dhaval was saying, and consumer, the sector that you track, in my sense, that is going to see the maximum change in the post-COVID world. I mean, we're going to think different, we're going to earn different, we're going to eat different, we're going to live different. How do you see consumption at large pan out in the post-COVID world?
There's so many different, I think the world will remain same. Some things will change for sure. The people want for hygiene will take a leap bound. Then the people want for convenience will take a leap bound. We will look to food as a category. If you see, all of us are working out of home and eating at home. So the ready to eat and ready to cook food will play a very important role. If you see the entire staple space, food is $100 billion industry, but the organized sector is hardly 20%. 80% is unorganized. To give you an example of a small thing like biscuit, people say biscuit is very organized. Biscuit is a 35,000 crore category. 1/3 is unorganized. If I were to take up all the local bakery stores around you, that itself is a 35,000 crore market. So the market itself is 50% unorganized. As people stay at home and as people look to eat at home, cook at home, they will look to have ready to eat and ready to cook food. And packaged food is the industry which will see a huge growth going forward. The other thing which I can think of is a quick service restaurant. In India, all of us want to have food at home. You know, Aisa, there are hardly any two brands in India with more than 500 restaurants. 10 years from now, we'll have at least 10 or 15 of them. So quick service restaurants will evolve in India. We'll not go out and eat anywhere. We'll look at hygienic places to eat out. The last part I would like to touch upon is the cosmetics. When people work out of home, the use of cosmetics will reduce.
Tell me about it.
Yeah,
No,
so I think
I'm an exception.
some part will reduce for sure. So the cosmetics may reduce, but the other personal hygiene in terms of sanitizer, hand wash will take a bigger factor. And companies who are able to evolve in this space are the winners. So food as a category, I think, is a huge opportunity. These companies can do at 10 to 15% CAGR for 10 to 15 years, and the personal hygiene space will evolve. So those are the things I think will change post-COVID.
Sure, makes sense. Dhaval Shah, let's get back to pharmaceuticals. And, let's talk about domestic demand here. Is the domestic demand robust for pharma? Or during this COVID quarter, there could be those volatile bouts because of overstocking of medicines? Just everyone's hoarding whatever they can lay their hands on right now.
So what happens is, if you look at monthly numbers, then, there is a lot of noise that you would see with, 1 month getting that overstocking phenomenon, but, and, the subsequent months were witnessing a decline. But broadly, if you were to look at a long-term trend for domestic market, there are key structural drivers to this long-term trend of what we are trying to look at. And, so if you were to highlight a few of them, first one is, favorable demographics. If you were to look at, India as a country with 138 odd crore population, 20% of our population is either above 50 years or children below 5 years, which actually require more medical attention. And, how does that pan out over the next 10 years? By 2030, while the population will also increase, the overall percentage of population which will require higher medical attention, which is above 50 years and below 5 years, will go to as high as 30% of the population. So, in the span of 10 years, we will be adding 20 crore more people who will require more medical attention. That's like adding a population as big as a Pakistan or a Brazil to, people who require more medical attention. And that's where is a structural driver when you look at, that the overall demand for pharmaceuticals in India over the next 10 years looks fairly robust. Another trend, you look at per capita income, and globally we've seen that as per capita income, increases, the spend on pharmaceuticals typically increase. So, here we are at around 3.5% to overall GDP in terms of the overall spend, and global average is somewhere around 10%. And that is clearly a trend which can actually increase. Third and very important trend is, again, government spending or expenditure on healthcare, as a percentage of GDP is only 1.5%. Even the emerging market numbers are closer to 3 to 5%. With COVID, I'm certain that, government will now want to expedite this. And earlier they were looking at increasing it to 2.5% by 2025. But that looks to be, fairly front loaded now in terms of what we're trying to look at. So there are a lot of structural factors which says that, to grow at around an 8 to 10% kind of a CAGR for the next 10 years for, domestic doesn't look fairly difficult from here on.
Okay. On that note, Chanchal, let's talk about, or actually, Dhaval, let me ask you my second question, Dhaval Gala. We're going to be banking differently in the post-COVID world. Already there is that emphasis on that I don't want to take cash transactions, digital payments are the next new thing. Do you think private banks which have a large digital presence automatically will get that edge as opposed to others who are still very lean in their digital presence in the post-COVID world?
So this is a very important trend, and it's definitely very important for entire financial services industry. One important thing we need to understand is that a few banks way back in 2015 had made a significant inroads when it comes to digital offering, as well as a significant wallets, ways of payments or channels of payment to do other than branch and ATM, which was the historical things we used to do for payment or collection or removing money. Now, if one has to understand post-COVID, if I have to just rewind and go to data after demonetization, almost 55% of transactions for the calendar year 2018-19 used to happen through non-banks, basically bank branches and non-ATM channels. So that's a very large number. And even in that non-bank and non-ATM channel, there is a wide ways of debit cards, credit cards, UPI transfers, and wallets. Everybody has a decent share. So the payment industry is doing really well. Recently, there was an organization who had a credit card organization also got listed, and we understand the euphoria around that. So point I'm trying to make is that post-COVID, the digitization pace will accelerate further. Definitely, social distancing will remain for longer, and in that backdrop, I think digital will only not be important for payment industry or payment side of the banking business, but also the loan disbursements, underwriting on interviews like this when one has to take a loan, and maybe servicing through Zoom or some Microsoft Teams or other apps. So these things would come into play materially banks have very well started doing that. Not just banks. If you look at industries in mutual fund industry, insurance industry, most of them have started doing really well, even when it comes to doing KYC on digital modes. So this is definitely key theme. In my opinion, few companies, maybe public sector banks or few
Right.
organizations are behind the curve to an extent, but I would say State Bank of India is doing really well on that. So if one has to look at few data points, when it compares to Western economies or Western countries, India has leapfrogged into digital when it comes to both payment as well as underwriting. Basically, both sides of the balance sheets really well. So I remain very optimistic. This side of the business doesn't get impacted whether it was COVID or after COVID. It only accelerates further.
Yeah, absolutely. Chanchal, digitization brings me to retail because I don't know when any of us would be headed to a mall or a physical store next. In this, norm of social distancing, you'd much rather prefer not to. More so for retailers, it's going to be imperative to have large digital presence. And if they don't have that, then they're going to be, clearly out of the race.
You touched upon a very interesting point. Digital is no longer a structural advantage companies will have. It's a necessity. You need to have it and you will have to have it. A couple of backs when I used to meet a company, I used to talk about what's the omni-channel strategy. Omni-channel is a new word. You have to have your omni-channel strategy. When I go out to a store, if I can't find something there, I should be able to order online. That was what company was building up. But today with the new COVID world, people are ramping up their online strategy. And going forward, we'll see retail, both in terms of e-commerce, will evolve. The other interesting thing is that local grocers, which were a dying thing few days back, local grocers have played a very important role in each and every one of our life. And I think someone who is able to digitally capture local grocers will be able to win over longer term. But if you see retail as a space, retail, the four big categories are grocery, apparel, and then you have consumer durable and jewelry. Specifically in apparel and consumer durable, globally, online has become some 40-50% of sale. In fact, even in India, 70-80% of mobile is sold online. So I think apparel and consumer durable is the one which will see fast ramp up in the retail space.
Sure.
Grocery and others will slowly evolve, but I think omni-channel is there to stay and digital is there to stay.
Dhaval Shah, what about healthcare? Can that as a segment grow faster as opposed to pure play pharma, or there's bound to be aberration there as well? Because non-COVID treatments clearly have taken a back seat right now.
Right. So, if you look at the healthcare as a pie, it has a lot of sub-segments, and pharma is just one of the sub-segments that you're trying to look at. Non-pharma is about hospitals, diagnostics, wellness is something which is there. And even include API and specialty chemicals there in terms of contract manufacturing. So, when we look at that pie, each of these sub-segments has their own nuances in terms of, where are they placed and how are you trying to look at from a growth perspective. Let's take hospitals. India, in terms of penetration, has 0.9 beds per 1,000 population. If you compare that with, overall global average, the global average is somewhere around 2.9. So just to give you a context, the whole of India for 140 crore population, we have total number of beds around 12.5 lakh hospital beds, which is what US has for almost 1/3 of the population that India has. And that is where there's a big opportunity in healthcare to actually improve penetration on a per bed basis that we're trying to look at. In fact, if you look at the largest private sector company today, has only 7,500 operational beds out of their overall pie of 12.5 lakh beds. So for many of these entities to keep on growing at around somewhere around 15% kind of a CAGR for the next 10 plus years doesn't look very difficult. And that is where it's a very big pie. And I think there is a bigger demand for private sector to come in and participate in that in terms of what you're trying to look at. Similarly, diagnostics, it's overall $5 to $6 billion kind of a overall diagnostics pie. But again, if I were to look at the whole setup, 45% of them are single mom and pop shops which are operating. India has this peculiarity that we have almost 1 lakh pathology labs which are there. versus our neighboring China, which has only 5,000. And in US, almost 85% is catered by only 5. So, here the top 5 players only command 15% of the overall pie, which will drastically change, over the next 2 decades. And that is where for them to grow above 15% CAGR for almost a decade is again, not far-fetched. So those are the 2 segments which are actually growing really well. What COVID has done is, this whole issue, API manufacturing as well as contract manufacturing that we were trying to look at for even specialty chemicals, which was more China-oriented. All of a sudden, the world has actually woken up that whether we want to diversify our sources. And, that is where, India has this big opportunity up there to grab. And if Indian companies get their act right, if government provides the adequate infrastructure to support them, in terms of building large parks, which a couple of state governments are actually talking about, then we can clearly see that in each of these segments we will be able to take up a large pie, away from our neighbor, and that will add to a very good growth rate that we're trying to look at for the next 5-7 years for each of these segments that we're trying to look at. So net, non-pharma healthcare looks, fairly exciting. They're faster growing than, overall pharmaceuticals that we're trying to look at. And we would expect they will form a larger proportion of the overall healthcare index as we move forward also.
Sure. Dhaval, if I could, come to you, Dhaval Gala, where does microfinance fit into the picture? And I say that because even right now the finance minister is talking, and in light of all the announcements made by her yesterday, the relief that was announced for the MSMEs. Now, the interesting thing is that some of these microfinance companies, which have huge exposure to MSME segment, most of these stocks or most of these banks are still trading at 2.7 times their price to book. Where would you put them in the investment scheme of things?
So, first about microfinance sector, right? That sector is fairly important. It delivers credit at an efficient manner to the bottom of pyramid. The sector has grown at 25% on a YOY basis for last 6-7 years. And if you look at NBFC, MFI, because there are many banks like Bandhan Bank or few small finance banks doing microfinance as one of the key business. NBFC, MFI companies have actually grew 35% between the last 7 years. Firstly, microfinance sector has been very resilient. Way back in 2010, they faced Andhra Pradesh crisis. Then every 3-4 years, the last one being during demonetization, they faced material issues. And what happens is that there are few companies who tend to not survive after that big sectoral or state related issues what they face. So they have largely been resilient and came back fairly stronger. Most of the sector has attracted a lot of capital as well, both on the debt and equity side. So what I would look at MFI companies right now would be, these are the most opportune time, because you would see in the next 2 to 3 months or 2 to 3 quarters, most of the problematic MFI companies unfolding and unable to withhold the problem. So you would find good companies within the segment who actually remains resilient and are able to provide for whatever NPLs they see in the next 2 quarters and come back stronger. So I don't know which companies you meant are trading at 2.5 or 3 times. I don't see
exactly the ones that you talked about, but anyway.
So they have valuations are already down for them, for most of them, and that's how they operate, right? They're most cyclical when it comes to, because every 3-4 years there has been one external shock, and they have come out stronger again and again. So during 2010, around AP crisis, the microfinance sector at large was less than 50,000 crores. Today, as we are discussing, microfinance sector at large is more than 260,000 crores of outstanding credit. So as I was talking about the growth rate, the sector has done really well when it comes to growing and reaching the bottom of pyramid, which remains one of the key agenda for RBI as well as Government of India. And maybe from an MSME package point of view, I think yesterday there was a 30,000 crores of package which was announced for NBFC companies below AA rated. In my opinion, a lot of MFI companies will be lined up to get money in, at least in that scheme.
Right. Johnson, what happens to consumer durables? And I'm just taking a leaf out of rural micro lending here. How do you think will demand patterns pan out when it comes to rural India as well as urban India? Because channel checks seem to be indicating that while rural India is not as impacted by the virus, but the demand is not really seeing an uptick there.
Consumer durable as a category, if I were to tell you, I'm very bullish on this space. For next 10, 15 years, there is huge opportunity. As power costs have come down and as the penetration increases. To give you an example, in India, will you believe it? The AC penetration is just 15%. Rural penetration would be less than 10%. So AC, refrigerator, there's a huge headroom for growth, and these categories will keep on growing for longer term. People will have AC in their house. People will buy refrigerator. Now, the interesting point which you highlighted was post-COVID what? You remember we were discussing about vacuum cleaner. So home automation as a space will grow post-COVID. So post-COVID, specifically in urban India, people will buy washing machine, people will buy dishwasher, people will buy vacuum cleaner. These categories which we were not thinking of buying, mostly all the urban will buy for some time. And these categories will also evolve in this space much faster than we think about. So consumer durable as a category, I think the penetration level are too low. We'll see the category grow for longer term. New categories will evolve post-COVID. Home automation, kitchen automation, these categories will evolve and grow much, much faster. So sometimes there may be some hit because of people may postpone their purchase because of uncertainty. But I'm very bullish on this space.
But in the near term, you do agree that cost rationalization may set in?
I don't know. Will you postpone your vacuum cleaner? I mean, I'm just trying to. Will someone postpone their dishwasher? These are important categories. You'll have to go and buy it. In rural India, people may postpone their AC, but they'll go and buy it. The moment they get more money, these are the categories must have. Cost of electricity is going down, so you will have to have this. You will have to buy things for your, to make your home better.
Yeah, convenience, that's what it is. And if all of us are going to spend more times at home, might as well invest in these appliances. I'm all for it. But Dhaval Gala, jaan hai to jahan hai, varna insurance hai. Will COVID act as that big trigger that we've always been talking about, that insurance, once it gets deeper penetration, that's the sector? Well, there's no debating and denying that. But could this really be that mega trigger for insurance? Or have you seen any changes in trends in the last 6 months to a year where AP is facing some moderation?
So, two ways to look at AP, right? So, basically, for all the audience, AP is annual premium equivalent, or the total premiums which is collected in each year, new business premiums. So, maybe today, India, on a life insurance premium collected basis, the total gross premium collected for the life insurance sector is 5 trillion, basically 5 lakh crore rupees annually. And if you look at protection business, which is term plans, which is only 20,000 crores. In the last 2 to 3 years, a lot of insurance companies have focused on selling more of term plans because they are high margin business, and the under penetration is significant in our country. Today, almost 92% protection deficit is one of the means. If you have to look at, we are underinsured by 92% when it comes to pure protection or pure term plan. And if one has to understand the number of people who have protection policies in India, they would be close to 1.3, 1.4 crore people having a retail term plan. So and I did not tell you what is our statistics on outstanding, number of people, population, or even the people who are earning, or urban population, urban job population is also fairly 10x or 12x the number of what actual insurance or term plans have been sold. So what happens is, when you sell term plan, you have a lesser premium collection versus a savings product. So one may not look at total APE growth as a way to look at. Maybe what one has to look at the sum insured growth, as well as how the protection business is scaling up, and that would drive profitability for most of the insurance companies. And I think COVID type of pandemic, whether it in India or many other countries, makes you start feeling to have more of protection. So yes, this would be fade for few months, because everybody will remain scared, and maybe the COVID continues for a little longer. You may tend to just buy more insurance rather than required or not required. At least people who are educated enough or who understand importance, they might buy extra insurance.
Yeah.
There is other angle as well. There is general insurance sector. Even that would see a significant fill-up in my view, because people are starting to hear about the hospital expenses. Maybe Dhawal Shah could talk more about it, but today also 70% of hospital bills in India are paid out of pocket rather than paid through insurance, medical insurance the people may have. So a point I'm trying to say is the retail insurance penetration is very low. A lot of us working in corporate India do have group health insurance programs. Even if one has to consider that, the overall, and even the government group health insurance scheme, which was started 2 years back, even now we only cover less than 50 crore people in country when it comes to health insurance. And the retail insurance, as I was talking, is only about 4 crores or 4.3 crores people. So if not term plan, but the retail medical insurance is definitely most important, and COVID would take that into account. The COVID experience may take that into account, and people would want to go for general insurance. So net, yes, this sector remains COVID free in terms of growth rates. What problems they would face is underwriting the insurance policies, because there is a lockdown and social distancing, and the policies, or for policies to get activated, you may need medical checkup or some pre-medical checkup. So there would be some issues when it comes to selling large insurance policies, but I think they would figure out that as well.
Yeah, that's a very pertinent point that you made. So great, we've got a great oversight on all the sectors that you track. But now let's talk about whether they're investment worthy or not. Let's talk about the valuations that each of the sectors that you all track are running at, and whether one can still go out and buy these names. And Dhawan Shah, let's start with pharmaceuticals. You know, do you really think valuations are still favorable, or with the recent run up and the re-rating that we've seen for selectively most pharmaceutical names, valuations are already at long-term averages? Or do you still find opportunity within pharma?
So with the recent run-up, the valuations have caught up with long-term average. So 1 year back, when we actually launched that fund, one of the 4 pillars was about trying to say that, the valuations are fairly attractive because of the fact that, they were almost 20% at a discount to a long-term average that we were trying to look at. And, now, as we speak today, that valuation has already caught up to long-term average that we're trying to look at. But more importantly, while I gave you the 10-year picture and told you that, pharma was in a bear market over the last 3 years, and, this year we're actually coming out of that bear market. So we've just started actually coming out of that bear market, over the last 8-10 months that you're trying to look at. So while valuations are in line with long-term average today, the outlook, be it on the domestic side of the business or the export side of the business, has actually improved over the last 1 year. And that is where I would say that, we're fairly more confident on the overall earnings growth expectation from this sector over the next 2 to 5 years than what we were 1 year back. And so to that extent, from here on, if you were to invest in the sector, you would definitely get returns which is equivalent to the earnings growth that is expected out of the sector, if not for any valuation re-rating, because you can also argue for that depending on how the outlook pans out for the other sectors. But even if not for that, earnings growth definitely is fairly robust for this sector, and that should be the incremental driver for the sector today.
Sure. Chanchal Birla, that's pretty much the going concern for FMCG too, right? I mean, there is a Unilever which is trading at peak valuations at an all-time high right now. While there's no denying that the sector is a critical essential, while consumers may look for value for money, we can't live without these products. But the valuations are rich, so that's the sticky point. Can you still buy afresh within pure play FMCG names?
No doubt about it. The valuations are rich, and they have been there. This has been the argument for some time now. But if I were to talk about companies where earning can continuously grow, We've never seen the derating happening for companies where the earnings growth compounding is there and there is visibility of earning. If you talk about FMCG in India, there is hardly $30 per capita spend. Compare this with a country like Indonesia, which is 2x, China is 4x, Vietnam is 5x. The amount of growth which can happen, and 40% of Indian population is less than 25 years of age. The headroom for growth of these companies are too high. Now, when you look to invest in companies, you look to invest in companies where there is earning growth visibility, there is a strong ROC, there is strong management, and the growth visibility is very high. Most of these companies have very high visibility of the growth. And the cash flow conversion to EBITDA, if you look at that parameter also of these companies, are very high. So some of these companies have corrected in this pandemic. But if you were to see in next 1-2 years, FMCG is where, again, you get high visibility because of the pricing power these companies have. They tend to pass through all these phase and they come out stronger in the after the phase. And remember, most of these companies, almost 50% of their operating profit is ad spend, which can be cut at this difficult time, or which can be rationalized. They can do a lot of digital spending and still maintain their share of voice. So I think if I have a strong earning visibility, and if some of this stock corrects a lot, we should add to this because the tailwind for longer term growth is very high here. And the ROC and the cash flow conversion defines which companies you have to buy.
So you're saying you would ignore the valuations that a Nestle, that an HUL are sitting and they're still a buy?
I'm not saying I'll ignore the valuation. I'm saying for sure some of these companies have corrected and they give a good opportunity to buy. So if I were to, I will not name any of the companies,
Sure.
but if I were to see the premiumization opportunity in these categories is huge. I mean, compare the amount of, so I spoke about $30 per capita spend compared to other average. I think the opportunity to premiumize and the opportunity to take consumers up the pyramid is huge. So the margin surprise can come. And if you see historically, companies have surprised us in the margin and the way they deliver profit. So if this company is correct, then you have to ramp it up and so will we do if you get a good opportunity to buy.
Right. Dhaval Gala, that can't be said now anymore for private banks, even the most sought after names within private banks, or for that matter, even within NBFCs. The route in the market is sparing nothing within financials right now. So valuations are not a concern, but where do you think have prices become that lucrative that you can step out and actually start at least nibbling into these names now across the financial sector?
So, definitely valuations is one important thing which everybody looks at. And you've already mentioned that the valuations are really lower or cheap when it comes to even for private banks. So just to take you to 2008 global financial crisis, what happened is there was similar route. Maybe the route continued for 12, 13 months, so you did not feel that. And right now it's been only in 2 months of COVID era that the prices have corrected really sharply. So I mentioned in the opening remarks also the franchise, how they are, the business model. So everybody's doing the normal same banking business, right? Taking deposits at low cost, trying to do it at low cost, making a good franchise of low cost deposit and trying to lend either to retail or corporate and trying to recover that money with interest. That's a simple business, actually speaking, to earn a spread. But not everybody is successfully able to do that in the past. You look at examples like HDFC Bank, what they went through 2008 to 12, or for that matter, other private banks, right? Most of them came back really sharp, well after global financial crisis. During then, we had a very good economic growth in the last 5 years, and therefore the NPL levels were very low for the system at large at around 2.5% to 3%. Today, when you look at overall system level NPAs are anyways closer to 9.5%. They would be going to around 11-12%, and I cannot make a judgment at this point how much more can they go and not go. But if you look at these top tier private banks, right, they would gain massive market share. Let's look at what is their franchise trend. So one, they have a low cost deposits, they have retail lending, they have digital capabilities, and today they are also able to cut cost or operating cost structures because they have become meaningful when it comes to market share versus what they used to have during 2003 to 2008 era. So the large private banks, in my opinion, will gain a lot of market share and a lot of profit share of the sector. Coming to valuations, most of these are trading at lower than the average valuations during global financial crisis 2008. Now we cannot paint the current era same as global financial 2008 crisis, or we don't know how long we should be going to history that the current era is comparable. And leverage being one of the key thing in the financial services business, so it's not easy to take a judgment for next 1 or 2 years earnings as well.
Right.
But I would say these large banks will get significant or disproportionate profit share till the time economy normalizes. And in that backdrop, the larger banks, the larger NBFCs, or for that matter, the top players within the each segment, whether it is insurance, life insurance, general insurance, mutual fund industry, NBFC companies, banks, most of these segments would have larger companies or profitable companies able to withstand the current challenges of COVID-19.
Sure, absolutely. Okay, on that note, gentlemen, it's time for our next session. So I'm going to begin thanking you all. It was lovely chatting with you and get an in-depth sense of where all these sectors of the economy are headed. Not just post-COVID in the interim, but also for the long haul. Dhaval Gala, Dhaval Shah, Chanchal, all of you, thank you so much for taking the time out and speaking with us today.
Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.